Imagine two people, both 35 years old, both living in the same suburb, both earning almost the same salary. One of them has $10,000 invested. The other has $500,000 invested. On paper, their lives look almost identical. But in reality, they are living in two completely different worlds. And by the end of this video, you will understand exactly what changes at every single stage of that journey, from your first $1,000 all the way to true financial freedom. Most Australians think investing is only about the number in the account. They think if you just get the number bigger, everything else takes care of itself. But that is not how it works. Every portfolio size comes with its own mindset, its own stress, its own temptations, and its own mistakes. The person with $10,000 is fighting a completely different battle than the person with $500,000. And almost nobody talks about this honestly, because most finance content only shows you the destination, not the road. This matters because if you do not understand what is coming at each stage, you will make decisions that are completely wrong for where you actually are. You will panic when you should be patient. You will play it safe when you should be aggressive. You will celebrate too early, or you will never feel like you have enough, even when you actually do. Understanding this roadmap is what separates people who build real wealth from people who just talk about it. Before we go further, if you are someone who actually wants to build wealth instead of just dreaming about it, hit that subscribe button now, because this channel breaks down exactly how money really works in Australia, without the hype and without the nonsense. So let's start at the very beginning. Let's talk about what your life actually looks like with your first $1,000 to $5,000 invested. At this stage, the amount of money itself does almost nothing for you. $5,000 sitting in an ETF is not going to change your lifestyle. It will not pay your rent. It will not buy you a house. And here is the part most people get wrong. They expect this money to feel exciting. They check the app every single day, waiting for it to feel like something. But here's where things get interesting. The real value of this stage has nothing to do with the dollar amount. It is about the habit you are building. This is the stage where you are training yourself to consistently put money aside instead of spending it. Behavioral finance research has shown again and again that habits formed early, even with small amounts, are one of the strongest predictors of long-term investing success. The person who invests $200 a month at 25 is building a skill that the person who waits until they have a lump sum at 35 simply does not have yet. The biggest mistake at this stage is impatience. People open their portfolio, see it grow by $11 in a month, and think investing is boring or pointless. So they stop. This is exactly where most people quit, right before compounding actually starts to matter. Now let's move to the next stage. $10,000 to $50,000. This is where things start to feel a little more real. At this level, your portfolio can genuinely start covering things. A market downturn might wipe out a few $1,000s of value, and suddenly, it does not feel abstract anymore. It feels personal. This is usually the first time an investor experiences real fear. Imagine watching the market drop 15% and seeing $8,000 disappear from your portfolio in a matter of weeks. That is the moment most beginner investors either grow up as investors or panic and sell at the worst possible time. Here's something most people never realize. Australia has been through several major downturns, including the global financial crisis and the sharp pandemic crash in 2020. And in almost every case, the market eventually recovered and moved on to new highs. But knowing that fact and actually living through the fear in real time are two very different experiences. This is the stage where your emotional discipline is tested for the first time, and how you react here often determines whether you will still be investing 10 years from now. At this size, many Australians also start comparing themselves to others. They see someone their age with a bigger portfolio and feel like they are behind. But comparison at this stage is almost meaningless because everyone starts from different incomes, different family support, and different life circumstances. The only comparison that actually matters is your progress against your own past self. Now here's something surprising. Once you cross into the $50,000 to $100,000 range, your relationship with money starts to genuinely shift. This is often called the tipping point stage because compounding finally starts to feel visible. At this level, market movements can add or subtract thousands of dollars in a single month, purely from growth, not from your own contributions. This is powerful, but it is also where a new kind of danger appears. Overconfidence. People at this stage often start believing they have figured out investing. They start taking bigger risks, chasing hot stocks, or trying to time the market because a few of their bets paid off. But here's the problem. A rising market can make almost any strategy look smart for a while. The real test only comes when conditions change. This is the stage where diversification becomes critical, not optional, because a concentrated bet that goes wrong at this size can set you back years. This is also usually the stage where people start thinking seriously about property, especially in Australia, where real estate has always played a huge role in the national conversation about wealth. Many investors face a genuine decision here.